In this video, we're going to discuss how companies raise capital, starting out as a privately held firm and growing over time toward a possible listing on the public exchanges, as well as how the growth and advancement of the capital markets has led to the mega-cap multinational corporations we see today. So we'll focus on that third objective of the modern multinational corporation and connecting it to what we've learned about the different legal structures of business, risk, and the capital raising process. When founders start a company, they may use their own money or pool their resources with others to start a company together. As these founders grow their business, they may need more capital to continue or grow the operations. In fact, many small businesses fail not because the idea isn't any good, but because they couldn't get access to any additional equity after they already started the business and are working on getting the company up and running. For example, let's assume we have a small bakery here in town. Let's call it Lucy's Bakery. And the baker needs an oven and wants to borrow $12,000 from the bank so they can increase their capacity to make more bread and therefore increase their sales and their revenue. But let's say the baker has bad credit, or the bank reviews the balance sheet and sees a lot of debt, and therefore they deny them the loan. If the business can't grow, it might stagnate, it could lose customers because it's not keeping up with demand. Because the baker can't secure the debt financing, she approaches her brother to see if he would like to become a part owner of Lucy's Bakery. She offers him a small percentage of ownership in exchange for the capital needed, and this is equity financing because she gave up a portion of ownership in the firm. And this ownership percent represents a claim on the future profits of the business. So if the business continues to grow and becomes a regional chain earning $1 million in profits every year, then Lucy's brother has made a very wise investment. If he had only lent her the funds, she would have paid him back and would have retained 100% ownership of her business. These are very simplified examples that illustrate how equity and debt financing work, but there are many different terms and conditions that can be added to these different financial interests. If a privately held or privately owned business like Lucy's Bakery grows very large and wants to continue its growth, it can open up investing opportunities to the wider public. What this allows a company to do is receive smaller amounts of capital from many, many different investors through the form of issuing stock on a public exchange. And this stock simply represents a percentage of ownership in the company and is a claim on that company's future financial performance. And companies do not have to ever list their shares on public exchanges and provide ownership opportunities to the public through this publicly traded stock market. In fact, many companies stay private, but can still grow very large in size. And did you know the grocery store Publix, a chain of supermarkets located throughout the Southeast, isn't actually a publicly traded company? Instead, it's privately owned with stock only available to current employees and board members. The company takes pride in calling itself the largest employee-owned company in the United States. And as private capital markets have become larger and more liquid, many successful companies have chosen to stay, or if they were already public listed, to then go back private. For many larger private companies, the option of staying private has also become more appealing, partly due because there's higher regulation standards in the private governance models. However, conditions in the public market may have also played a part, such as increasing costs to list, the daily, quarterly, annual public market disclosure requirements, all of the regulation and scrutiny from the public market can discourage companies from going or staying public. So while some of our benefits of accessing the public markets could be larger pools of capital available, this allows our founders a way to cash out a portion of their ownership. You know, for example, if you were Mark Zuckerberg and you started Facebook and now it's worth $1 billion of value on paper, one way you can cash out and to diversify your own wealth and investments is to sell a portion of your company. Because even if the company's valued at $1 billion, that's not liquid cash and you can't necessarily walk away with it and spend it. But by selling a portion of your stake of ownership in the company, founders can get liquidity by cashing out. Because publicly listed stocks are easily traded on the stock market and you can submit your share to the market, sell it to another buyer very quickly and easily, there's less risk of not being able to find a buyer when you want to sell your shares. So in the public markets, there tends to be a lot more liquidity, and there's less risk when there's not that illiquidity risk that you wouldn't be able to get your money back out of an asset if you needed to. So the flip side of that is that the company that needs capital, when you invest and buy their stock, they then should have a lower cost of capital, because we remember that relation between risk and return. So if there's less liquidity risk in the public markets over the private markets, then on the demander of capital side, the company that needs your capital, remember your return is their cost. So that should have a lower cost of capital for companies needing to access funds through the public markets. And some of the drawbacks of being publicly listed is that there's a lot more regulation. Once a company is listed on a public exchange, it's governed by the rules and regulations of the Securities Exchange Commission, and it's subject to the scrutiny of the public. And if the public doesn't like decisions that the managers are making, they can sell the stock. And because of supply and demand, if a lot of investors sell off their stock, that's going to create more supply and it's going to drive the price of that stock down. So if you're privately held, you are not legally required to disclose your financials. And a lot of times public companies, in those financial documents, that's information that competitors can get. So there's a lot of transparency in the U.S. capital markets. And that helps promote investor confidence, helps protect investors. And this very robust legal environment in the United States that has this emphasis on accountability and transparency in financial contracts and in publicly traded stocks that has allowed the U.S. capital market to grow so significantly in size and attract companies from all over the world. So one trend we've seen is that companies are waiting longer to go public, if they ever do go public, and the overall amount of investment in privately held companies has increased over time. A more developed and sophisticated industry has been built up to help facilitate the transfer of capital from large institutional investors like pension funds and endowments or wealthy family investment offices into these private companies. So these companies now have a lot more opportunities to seek capital to grow their operations than ever before.